Hello and welcome to session 12 of our Series 7 exam overviews brought to you by Passing Score, where you can get more help on your exams at PassingScoreFinance.com. In this video, we'll be doing a bond overview. These are the main features of bonds in general, including some of the features, risks, and interest rate effects that bonds are affected by. First, let's define what a bond is. It's a contract to lend money between an issuer and an investor. The issuer is the debtor, the person borrowing the money, and the investor, the one buying the bond, is a creditor lending money to the issuer. The contract that lays out all the major features of the bond is called a debenture, and the coupon, the regular payments, if there are any, of interest being made on the bond is the nominal yield. Registered bonds are where there's a record of the owner and address for purposes of paying the principal or the principal and interest. Book entry form is when there's no physical bond at all, it's completely digital. If the price of the bond is below par, that means that interest rates have gone up since the issuance of the bond. A key thing to remember is that there's an inverse relationship, an opposite movement between the bond price and an interest rate. If bond prices go down, that means interest rates have gone up. And here's some ways where we reflect that. The market price of 95.5 reflects the formula here of the bond price times the par value to get to the market price, in this case $955. This lower market price, the price below par, helps the yield of the bond to go up and match the current market values or market interest rates. A premium bond means that the price of the bond has gone up, which, as we know, the interest rates have moved in the opposite direction. That means market interest rates have gone down since the issuance of the bond. And again, we can see this formula, bond price times par value, to get $1,027, which is above the par value of $1,000, which means interest rates have moved the other way. So we have to increase the price of the bond to lower the yield to match the market. There's different types of maturities of bonds as well. There are serial bonds, which have maturities or payouts of principal over regular time periods before maturity of the bond. A term bond is just a payout at the maturity or the end of the term of the bond. And a balloon bond has a large payment somewhere between the initiation and the final term of the bond. A zero coupon bond has no coupon or interest payments until the end of the term. So there's an initial purchase and then the return of the funds along with yield, which reflects the interest and coupon payments at the end of the term. This makes zero coupon bonds more volatile in price than coupon-bearing bonds. There's different types of yield methods to calculate the return of a bond. The nominal yield is just the stated rate of the bond, the coupon interest rate, let's say 5% payment that's made over the life of the bond, and this won't change at all over the life of the bond. The current yield tries to relate that payout to what the current market price of the bond is, and we can see the formula is the total annual dividend or interest payments divided by the current market price. A yield to maturity takes into account a shorter time or life of the bond that can occur if the bond is called or put or otherwise paid early prior to the final set maturity. So the yield ends up being a little bit different since it's over a shorter time period. Bond prices can take different forms, such as this dollar price, the percent of par, or a dollar cost. The price of a bond can affect the yield, as we saw with the nominal and current yield calculations, depending on what market interest rates are. When a par bond means that the market interest rates are the same as when the bond was issued, so the The nominal yield is equal to current market rates. So the nominal yield on a par bond doesn't change. It's fixed for the life of the bond. And the current yield is, since the bond is selling at par, it's the same as the nominal yield. There's no change. The yield to maturity is also the same as the nominal yield, since again this bond is at the current market rates. Now this changes, these different yield calculations change when interest rates start to move around. A discount bond means that market interest rates have gone up since the issuance of the bond. So here we have our nominal yield, which is fixed for the life of the bond, no change there, but the current yield is higher than the nominal yield, since now the bond is at a discount to match the higher market rates. The yield to maturity is also higher than the nominal yield and the current yield, since this takes into effect the higher return and the discounted price of the bond when it will be, which it will be returned when it's redeemed at the full value. So the yield to maturity is higher than the current yield, which is higher than the nominal yield. Now a premium bond means interest rates have gone down since the issuance of the bond. So let's look at the nominal yield. Again, that's fixed for the life of the bond, no change, but the current yield is lower than the nominal yield since the bond is sold at a premium. It has an additional amounts which is reflected in that higher price, which lowers the yield of the bond. And the yield to maturity is less than the current yield since that premium has to be amortized to get down to the normal full par value. So we have a yield to maturity which is lower than the current yield, which again is lower than the nominal yield in the case of a premium bond. Now here's some examples of the different interest rate scenarios that can occur over the life of the bond. This is a normal yield curve, and this reflects normal market conditions where interest rates go up as the length of maturity increases. And we can see the lines start to move up as that maturity starts to get longer. Now a flat yield curve means that there's uncertainty in the economy, that things are unsettled, and no matter how long that maturity stretches out, yields don't seem to be getting any higher. An inverted yield curve means that there's pessimism in the economy. People don't expect very good returns in the future. So as yields, maturities increase, the yields of bonds tend to get lower. Inflation risk is one of the first and most important risks for any types of fixed income, especially bonds. These reflect expectations of price increases in the future and are discounted from the yield of a bond or any other type of investment to get the real interest rate. That reflects the purchasing power of that money after inflation is taken out of it. The real interest rate reflects your real buying power. The higher the inflation rate, the more that the return of the bond is reduced. So you have to take that into account when looking at future risks of the bond. Credit risk is the risk of a default of either the principal or the interest. Normally it's not a company hasn't been totally wiped out. There might be some return, but not complete return, not the promised interest and principal that was set out at the issuance. Bond ratings are a measure of the willingness and ability of the issuer to meet its debt obligations and reflect the risk of the bond. U.S. government bonds are considered to have no credit risk. It can have other types of risks, such as inflation can affect it, but not credit risk. Rating services measure the credit risk of different bond issuers. Moody's, Standard & Poor's, and Fitch Investor Services are the main ones. Call provisions are provisions which allow the issuer or borrower to pay back his loan early before the maturity. There can be some incentives to pay back early if interest rates have declined. and which means that the issuer can refinance their loan for lower rates. There's different features which can be included in the debenture which protect the investor from being called too early. There can be a call protection restriction which does not allow the issuer to pay back their debts until the first 5 or 10 years. That means the investor is protected against their money being refunded to them earlier than expected. There can also be a call premium, which is an additional amount paid above the par if the bond gets called. So it compensates the investor for their loss of interest that they would have received if the bond hadn't been called. And the investor is then subject to reinvestment risk. Since this is likely to happen when rates have gone down, that means the return of their investment will be lower since they'll have to reinvest at the new lower market rates. Prefunding is when an issuer is able to fund their account early through an escrow account which services and continues to pay. So it's not a call, but it's what's called a defeasance, is when the debt is covered through an escrow account, and then the issuer can remove any types of collateral or liens against their company or its assets because they've set aside all the cash to meet their bond obligations. A put provision is where the bondholder can ask for their money back from the bond issuer. This can occur when rates go up so that they can reinvest that money at the higher market rates. A control relationship is important and can be mentioned on the Series 7 exam as well. This is where the broker-dealer controls the debt issuer or debt servicer, or has some kind of a significant relationship with whoever it is that's issuing the debt. Prior to execution, the broker-dealer has to disclose this kind of relationship to their clients and obtain written authorization for any discretionary accounts. Well, that's it for our bond overview. If you have any questions, please feel free to email me at john@passingscorefinance.com, and good luck on your exam.